Hello, entrepreneurs. Joe DeCharis, CPA, coming to you live from downtown Flushing, New York for another amazing episode of How to Win at Business. And tonight, folks, I'm going to talk about something that's really been irking me for a long time. And that doesn't matter if it irks me, because if you're watching live, I'd like you to give me a hashtag live. If you're watching the replay, give me a hashtag replay. And if anything I say resonates with you, if you want to reach out to me, I have a free consult for anybody that needs some help, some quick advice. Maybe you have a problem that nobody's giving you a straight answer to. So all you got to do is go to timewithjoe.com, and I would love to help you with any sort of tax or accounting issue that you have. And tonight I'm going to be talking about what triggers an audit. People fear the IRS. And I understand that, and they should be feared. They're the biggest collection agency in the world. Okay, they have a lot of resources. Most of their resources are spent on policing us. Okay, I have slides and stuff. I'm not gonna share them tonight. I'm just gonna talk. But there's 4 different divisions of the IRS. One of them is responsible for self-employed individuals, small business owners, which is the bulk of all the businesses that exist. There's over 30 million businesses in the US. 25 million of them are still classified as sole proprietors. And that's where a good portion of the IRS's resources are allocated to. That's the truth. They're not here to serve us. The IRS is not here to serve small businesses. So once you understand that, you can start to realize what you need to do to protect yourself. And it really is a case of, trying to protect yourself against the machine, and you would think that after all these times, I would know to shut off my phone. Sorry about that, but that might be the machine talking back to me. I don't know. But so the IRS is this huge organization that has a lot of resources, and they're not our friends. Okay, so know your enemy or your opponent. Okay, so if you know your opponent and their tactics, you have a much stronger chance of surviving the gauntlet, is the way I like to look at it. So the first thing you have to ask yourself is, well, who are they auditing? Who do they target? Now, as a CPA, I've worked with thousands of business owners. I have handled hundreds and hundreds of tax audits, all kinds of tax problems, thousands of tax notices, any kind of situation you can think of. A lot of them seem complicated, but when it boils down to it, there's always common denominators. There's some trigger. There's some reason why somebody got audited. So in my experience, the people that get audited the most are sole proprietors. Not because there's more of them. I'm talking percentage-wise. If you're a sole proprietor, you're 1,000 times more likely to get audited than a corporation. That's just the way it is. So out of the 5 million corporations, the corporations that are audited are the large ones. The IRS actually has offices in, I'm talking about things like companies like Amazon and IBM and Google. They're there full time. They might have a whole floor, and they're looking at everything that's going on, okay? That's not what I'm talking about. The smaller corporations, the people that have corporations that are grossing, 50, 100, 500,000, a million. But that's the bulk of the corporations, okay, when it comes down to it. When you look at the numbers, percentage-wise, and you compare it to who gets audited, by hands down, it's sole proprietors. Now, you won't find these statistics anywhere on the internet. They're not going to be public knowledge. The IRS is not going to acknowledge, who they audit and why. You're not going to get it. This is inside information, if you want to call it that way, if you want to call it that. This is based on years of experience being in the trenches with clients. So sole proprietors are targeted. Now, if you're a sole proprietor and you're doing it yourself, that's even worse. Okay, so sole proprietor doing it yourself. Okay. Now there's income triggers also. So if you're a sole proprietor and you're doing 10,000, 20,000, that's not a big audit risk. Start getting into 30, 40, 50,000, and you start writing off a lot of expenses. It's pretty much common knowledge that, not common, but if you're over 125,000 on a Schedule C and you're doing your own return, it's seriously at risk. If you're doing your tax return on TurboTax, and I'll tell you why, it's pretty simple. When a CPA or an enrolled agent or a tax attorney does your return and they sign it as a professional with their identification number, the IRS, they say, hey, this guy, this professional has been doing this for a long time, and his track record is nobody's ever, there's no problem. I am not a criminal accountant, and there are criminal tax firms out there. So, that's another story. So if you're a sole proprietor and you're getting your return done by some shady schlock firm, you're at risk. Okay. So why do they target the sole proprietors that are doing their own return? Because most of the time they're commingling stuff. They're sloppy. Sole proprietors are all over the place. Most sole proprietors are just trying to figure it out. And the last thing they're thinking about is, creating books and records and having things reconciled. So the IRS knows this. It's like shooting fish in a barrel. And that's the story, folks. As a CPA, I have had one client audited. No, as a CPA, I've had 0 clients audited. And the only reason I could think of is that because I have a CPA designation, and because I've never, committed I've never committed any kind of fraud. I've never had a client accused of fraud or tax evasion. And so that counts. That counts. Now, if you're with a criminal firm, which I have worked for criminal firms, and I left because once I found out that they were criminals, I didn't want to work there anymore. They got a lot of people audited because of their track record. So it's simple. It's pretty simple. If you don't want to get audited, you need to have an accountant, number one. Number two, if you're in business and you're doing any kind of, or plan on doing any kind of business, I mean, as an intentional business owner, as an intentional person, not putting your head in the sand and looking at what you're actually doing. If that's you, then you should be a corporation, either a C Corp or an S Corp, because they just don't get audited. So it's pretty simple. If you don't want to get audited, take your business, create an S Corp or a C Corp, depending on your current tax situation. And the chances of you getting audited go from, maybe 3% to 0.00001%. So that's my story, folks. I'm sticking with it. Like I said, if you want to talk to me about if you've gotten audited, if you have a tax problem, feel free to book time with me. It's what I do. I spend a lot of time on the phone with people, not on the phone, actually, in Zoom calls. But, we talk about business and we solve problems. So thank you, and God bless, and good night.